Workday's founder just grabbed the wheel again, basically declaring war on, quote, vibe coding and AI parasites getting a free ride on their enterprise data. You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is February 24th, 2026, and we are digging into Workday, ticker WDAY, and their Q4 print. They build the underlying HR and finance software for half the corporate world. But today, I don't know, Mira, we've got solid backlog growth, but also this cratering GAAP profit and some wildly confusing guidance. What is the baseline here?
It's definitely a complicated quarter. I mean, top line looks fine. Total revenue was $2.53 billion, so up about 4% sequentially. And subscription revenue hit $2.36 billion. But the whiplash is totally on the profit side because non-GAAP margins look great at over 30%, but actual GAAP operating income down to just $174 million.
Oh, wow.
Yeah, it was $259 last quarter, and the drop is because they took this localized $130 million restructuring charge right at the buzzer.
Just a quick sanity check for our lawyers. Everything we say here is just personal opinion, not financial advice, but that restructuring hit definitely shook the tape, right? Because this stock was already having a rough time.
Right. Look, the stock was in the steady downtrend all quarter. It gave up about 27% leading into today. And then the moment these numbers dropped, it just gapped down. It shed roughly $9 in minutes after the bell and closed the extended session down over 9%, sitting right at 118.30.
Oh, geez, that is painful, but I feel like the after-hours selling was mostly triggered by the guidance, not just the quarter. Wait, let me make sure I'm reading this right. They guided Q1 subscription revenue to $2.335 billion. Does that mean they are expecting to literally shrink sequentially?
Yeah, that's the massive red flag today, an implied drop of around $25 million from Q4. I mean, for a mature SaaS platform that runs a 97% gross retention rate, seeing a quarter-over-quarter decline is practically unheard of. Management blamed fewer calendar days in Q1 and the roll-off of a big Department of Defense contract.
The DIA contract, right?
Exactly. But even if you pulled the $15 million defense overlap out, the math still implies they're contracting organically by about $10 million.
Which is wild. And it is perfectly timed with Carl Eschenbach stepping down and Aneel Bhusri returning as sole CEO. He is dragging them into this Chapter 4 AI era, and he sounds kind of angry. He said deterministic enterprise apps need to marry AI, but he called third-party AI agents parasites for just extracting Workday's data without paying.
Yep, it's the end of the free ride.
Right, so they are rolling out something called flex credits to charge an API consumption toll, which shifts them away from pure software as a service.
Exactly. They want to tax the scrapers.
All right, let's get into the details on how these flex credits actually work and why that late restructuring charge might be hiding something bigger in their margins.
So, looking at these flex credits, it is actually a massive philosophical shift for them. Workday has always been the ultimate predictable SaaS business. You buy the seats, you pay the annual fee. But now, with every external AI agent wanting to query their records, they realized they were leaving money on the table.
Because the data is the gold, right? If you are building a slick AI tool for HR, you absolutely need Workday's underlying records to make it work.
Exactly. And Bhusri he was pretty blunt about it on the call. He literally said, there are some vendors out there that I would consider them at some level parasites on Workday. He said they get a free ride and Workday is putting an end to it.
Tell us how you really feel, Aneel.
Right. So flex credits create this new consumption-based pricing tier. It turns Workday into a toll road. Every time a third-party model pulls data, ka-ching! But the catch is that consumption revenue is lumpy. Wall Street loves SaaS because it is recurring. Usage-based pricing fluctuates.
Wait, hold on. Can I jump in? Is that why their guidance feels so unstable right now? Just the volatility of shifting to this new model?
I'd think so, partly. It definitely introduces volatility. But honestly, the bigger story is what this means for their profitability goals. Because under Carl Eschenbach, they were in this phase 3 or chapter 3 phase. Carl was squeezing out operational efficiencies and expanding margins.
Right.
But now Carl is out. Aneel is back solo. He calls this Chapter 4, and his first move is basically to slam the brakes on margin expansion.
Which completely explains that restructuring hit. I mean, you do not just take a localized $130 million charge at year end unless you are dramatically shifting the internal architecture.
Exactly. Earnings mentioned they flattened the sales organization. So Patrick left, and regional leaders now report directly up to speed up decision-making. That restructuring charge smells a lot like severance and a massive reorganization to get back to founder speed. And they are explicitly capping their non-GAAP operating margin guidance at roughly 30%.
Wow. So they are just opting to hold margins flat. Actually, CFO Zane Rowe said something exactly like that, right? I have the quote here. He said they are prioritizing incremental investment in their agentic AI roadmap to capture a larger market opportunity.
Yeah, and that is, it is a really risky game to play when you're also reporting elongated deal cycles in government and healthcare. Look, they just spent $1 billion cash on Sana Labs. They bought Paradox, HiredScore, and Evasort over the last few quarters. You would think they would try to just digest all that.
Wait, but didn't management say they are stepping back from acquisitions?
Yeah, they did. They explicitly said they are leaning in pretty heavily on organic development now. So no more buying growth for a bit. They're going to build it in-house. They want to integrate the deterministic ERP, which is, the boring but critical stuff like payroll compliance, with probabilistic AI. And Neil actually called it peanut butter and jelly.
Deterministic enterprise apps and AI are peanut butter and jelly. That is such a tech founder thing to say.
But it is actually working. The Sana integration allows workers to launch AI queries right inside Workday. They already crossed $400 million in annual recurring revenue from these emerging AI products alone. That's over 100% year-over-year growth. And Garrett Kazmaier pointed out their self-service agent reduced HR case volume by 25% for early access customers.
That is an incredible productivity stat. Like, if you're a CHRO, that just pays for itself immediately. Okay, so I'm seeing the whole picture here. Aneel is back, he cleared the decks, capped the margins, and is betting the entire farm on native AI tools while taxing anyone else trying to use their data.
That's the thesis. It's a highly aggressive founder-led pivot, but transitioning from predictable SaaS to partial usage billing while flattening the sales org, it's going to create a lot of turbulence in the numbers for the next few quarters.
Fascinating. So where does this leave them heading into next quarter?
It leaves them with absolutely zero room for error on execution. I mean, the market is already punishing that Q1 sequential decline. So over the next 90 days, they have to prove this new flex credits model can actually cover whatever traditional SaaS growth they are, kind of leaving on the table.
Right. And they need those government and healthcare buyers to wake up, because if those deals stay delayed, the story shifts from a strategic pivot to just plain losing ground.
Exactly. But look, I think the broader takeaway here is that we are watching a massive software company rewind the airplane in midair. Aneel is looking at the next 5 years, and he clearly decided that just milking 30% margins was a trap.
Wait, so you actually think it is a smart move, sacrificing that short-term profitability?
I think if they do not own the AI agent space themselves, someone else is going to scrape their data and eat their lunch.
Which is such a classic founder mindset, right? Like the hired CEO brings discipline, but the founder comes back and just wants to build a new empire.
Yeah, founders do not optimize, they conquer. And right now, he is betting the margin cap on winning Chapter 4. If those new agents keep cutting HR workloads by 25%, he might actually pull it off.
So a massive gamble on productivity over predictability and a very expensive warning shot to the entire tech industry.
An expensive toll booth for sure, but yeah.
All right, we'll see if Wall Street actually has the patience to let them build it. That's a wrap for our Workday deep dive today, but please stick around for a quick note on how we put this show together.
Okay, that is enough damage for one episode. If you want these earnings drops to just show up for you, go ahead and follow the show. And as a quick reminder, this is an AI-assisted project where we pull the raw transcripts and filings to summarize what actually matters. If you have feedback or a ticker you want us to look at, just email us at earningsunscripted@datamadness.ca or check the X link in the show notes. Thanks for listening.
And we will catch you next time.
Have a good one.